having a look at here before we actually get into talking about stock by stock is just having a look at a bit of a macro dashboard, if I could, just to sort of take a snapshot of where we are now versus where we were sort of last reporting season, and maybe even looking back sort of 5 years. And I suppose I've broken it up into interest rates, inflation rates and FX. And if we have a look at interest rates first, obviously that matters. So they can carry a lot of debt. So I like to look at what's happening with the interest rate. So what do we got here? So the Bill 90 there, that's the short term, the bank bill rate, has been coming off. So that's very good for stocks that have got unhedged debt. And typically there is a degree of unhedged debt within each of these sort of debt portfolios for the companies that I cover. The medium-term rate, so I keep a look at that interest rate, that 5-year interest rate swap, and that's actually been heading up just a little bit, but it's still about 200 basis points down on where we were 5 years ago. Why does 5 years matter? Well, usually companies in my coverage have long-term debt that they put in place. As it rolls off, it gets refinanced. We're going to see just consistent downward trend in the on the debt refinancing costs. So that's a positive, even though we see in the long term, if I point you there to the CGB 10, so the Commonwealth Government Bond 10-year rate. As we know, we're all watching that one. It reached ultra low levels and it's starting to come off that low. Certainly that matters for discount rates, but we use 3% risk-free rates generally within research for our valuations, so plenty of fat there. And also there's a benefit from that for at least the regulated utilities that feeds actually into their revenue streams. Also worth pointing out, we're a long way off where we were, last year or even 5 years ago. So still at very low levels. Inflation, so also watching inflation here. So the last inflation read that we got from the Reserve Bank, 0.9%. So way below the 2 to 3% band that they've got. Thank you very much to the smokers out there. Tobacco prices increasing by 20% helped to actually boost that. So the ABS actually called that out as being the biggest contributor to the CPI there. So without that, we might have been in a lot worse position. Also like to track what's going on in terms of expectations on CPI. You might know that the RBA puts out a forecast. Short term certainly is looking at a spike of 3%. But they also forecast out through to June 23. If you average through that, they're only targeting like 1.5, 1.6%. So still well below that target band. I also like to look at very long-term expectations, and that's built into the yield curve. And that's certainly moved up. The break-even rates are around about 1.9% at the moment. Still well below that sort of where we've been historically in that midpoint of that band, but certainly moved off the bottom. And it's worth actually noting then, if you think about the nominal rate less the inflation expectation, that's real rate. The real rates have actually come off a little bit. So that's quite actually supportive for stocks and for infrastructure over time. Just the other thing that I'll look at too is the FX rates, because there are stocks that own offshore assets. They've moved up a little bit. That's obviously not good for values, but it's also not good also for those businesses that whose customers earn revenues in US dollars, etc. So, for example, the coal mining companies. It is also not actually great for inflation, because obviously higher Aussie actually reduces import prices, so it has an impact on inflation. So how do I read through that? Look, the FX is not a big deal. The higher inflation is good, and we have to keep a bit of a watchful eye on what's going on with those bond rates. But overall, not massive movements there to be concerned about. If I can then flick through to my coverage list. So this is a coverage summary I like to keep an eye on. You can see from that table there, you can see where we are against prices 12 months ago, still well off. You can see my expectations for next 12 months total shareholder return. Got my rating, got my the target price there, and you can compare me to where the Bloomberg average is to see whether I'm absolutely crazy or not. Upside to that target, and then the yield and distribution expectations, including with the franking and also sort of 3-year out growth profile. So you'll see there that I've got ad ratings on APA, Atlas Arteria, Horizon, Dalrymple Bay and Sydney Airport. I just want to touch on a couple here that I'm getting questions coming in from the network on, and that's Horizon and APA. And I think we can actually bundle these together because they are transporters of fossil fuels. If I look at their revenue quality, if I look at their short-term cash flows and their balance sheet over coming years, there's nothing in there that I can see that can do sort of material damage to their valuation, at least in the short term. Certainly there's recontracting risk. It's something that we have to watch out for. We don't get full visibility on that, but certainly when they talk about average contract terms, they're quite long dated. So what's going on here in terms of their share price retreats? Look, I think the ESG thematic is no doubt about it growing, and I think that compounds with the index effects. The other things I can think about here, high discount rates obviously playing in, reinvestment opportunities. If we look at AGL the other day where it did its write down on its renewables book, I think that actually plays through into APA too in terms of its ability to deploy capital into renewables at reasonable prices and getting decent returns. I think there's concerns then as we look even longer term about asset stranding risk, and that it plays into the terminal value sort of numbers. And that really comes down to this focus of companies and countries on this zero net emissions by 2050. So certainly something we have to watch for. If I run the numbers in terms of modelling and I sort of go, okay, well, how much of a decline do we actually need in our long-term value out, starting from 20 to 30 years out and declining? For both APA and Horizon to justify the current share prices, you've got to assume effectively 2% decline in perpetuity from out that 2030, 2040 sort of timing. Is that reasonable? It's in the eye of the beholder, but I think between now and that point, there's a lot of cash generation coming out of these companies, which will allow them potentially to pivot into other areas to sort of justify that long-term value that we've got built into our valuation. So I still think they're reasonable buying at current prices. If I could just move on, before we to move on to the next, just some notable mentions in there. AusNet, you might look at that and go, well, that's a pretty solid total shareholder return potential there. AusNet's got a really interesting pattern where it ramps up pretty heavily into its result, into its X date, and then falls away. So it's certainly come right back. So and its next reporting date is actually in May. So now might be actually not a bad time to actually start grabbing some of those on the assumption that that same pattern that seems to be pretty consistent actually happens again. You can see where my target price is, and it's yielding actually some fairly solid cash generation there. So pretty good on that front. Bingo, that's one for the equity ARB players. As you know, it's an indicative bid at the moment, but it's at $3.50, and the share price has actually been coming off. So if you're willing to bet that actually goes through, it's not actually bad buying in at the moment. I should caution though, like I've always been talking about this year as being a weaker year for Bingo. The Boral result yesterday, referencing sort of weakness in pricing and volumes for them, I think is a reasonable read through for Bingo. So I've got a 16% decline in EBITDA for Bingo for this half. Certainly the cash generation, the EBITDA potential, that portfolio is very strong once we get the cyclical uptick coming through. Cube, got a reduced rating on that. Look, it's definitely been going against me. I've got the reduced rating on the basis that the valuation implied in the share price looks very stretched. Still waiting to hear what's going on with Moorebank. They said they'd have details on a transaction before Christmas, and still hasn't come through. And the other one I'm getting questions on, Cleanaway, obviously Vic Bansal leaving, so driving force behind that company is gone. Be interesting to see who replaces him and what that does for the culture of the company, because I hear there was some fairly nasty stuff going on behind the scenes, but certainly the cash generation of the business and what they were doing in terms of improving the performance of the company has been very good. So, below $2.20, we're not far from it. It's getting back into some pretty good buying territory. Things I'm sort of considering going through the reporting season, just very high level stuff here. Most impacted by the bond rates. We've already talked about that, but I think that's the APA and the regulated utilities. Most impacted by COVID, no doubt about it. The patronage risk assets, so that's Atlas, Sydney and Transurban. But also, without a doubt, the other stocks in my coverage have been impacted, whether that's economic activity, inflation, even population growth, which is just so important for this space. Potential capital raising candidates, certainly questions I've got coming in from instos, particularly on Sydney Airport this year. Possibility of capital raising, I don't think so. I think there's heaps of liquidity there, but I'd put it at probably at 10 to 20%. Next year, we could, if traffic's still pretty miserable, we'll be having this same conversation, and the likelihood is it's likely to be picking up. But they're getting $200 million of cash coming in from the New South Wales government this year based on a land transaction, which should help to top up their coffers. APA, look, I only put that, his balance sheet's very strong, but if it buys an asset, we've been talking about them potentially buying one in the US for a while, they'll need capital for that. And Transurban, well, it's very much shown its interest in the buying out the remainder of WestConnex. The New South Wales government is selling the remaining 49% of that in 2 tranches. Now, Transurban did a sell down of its US assets, netted a decent amount of cash. I think it can use that to help out at least with the first tranche. But the second tranche, certainly, I think they'll need some capital. So I'm valuing half of that WestConnex at around about $5 billion. So we're talking $2.5 billion maybe for that second. So it's not huge in the context of Transurban, but certainly I think they'll need it. Buyback, the only one across my sector that I can sort of see doing that is Horizon. It's sold the Acacia Ridge terminal. It's completed that. That's another $130 million it should be able to throw into that. Plus, it has the ability to ramp up the leverage within its above rail business by another $1.2 billion. So very much can see just ongoing buybacks coming through from the company over time. Distribution uncertainty. So if I just go through those, Horizon, when I say that, it's because it pays out 100% of its accounting earnings. So it just depends on how that plays through. Atlas Arteria, well, once again, that's dependent on the French asset and how much cash it actually pushes through. And Spark, first-time distribution guidance for FY21 will come out with its result. And I think that could actually be on the decline, that distribution from the 13.5 cents currently. Franking, very interesting bit to come out of the federal budget. You might remember there was the allowance for immediate expensing of CapEx if you started a project after the budget and completed it by June 22. What that does for these very capital-intensive businesses, it means that it could actually mean that they don't actually pay tax during that period. That means no franking. So it could actually mean that the franking component dries up for those who are looking at that franking side of things. ESG headwinds, well, we've already talked about Horizon and Dalrymple Bay. We know about it. APA. Look, the other two I need to kind of point out here, which I think is kind of interesting. Sydney Airport. Airports over in Europe are actually getting a bit of pressure in terms of flight shaming. So where there's pressure on them, on people actually flying because of the carbon emissions from a flight. So I don't think it happens to Sydney Airport just because we're so removed from the rest of the world. You've got to fly to get to us, and we've got such big distances between the metro cities. But just something over the long term it could play through. Cleanaway's the other one. I mean, it gets big ESG credentials, but it runs one of the biggest diesel truck fleets in the country. I always find that interesting that it gets the positives on ESG, but that could end up swinging another way if the market started to fixate on that. But just something to think about. Revenue announcements that I'll be thinking about. Horizon always updates with its contracting position. I'll be watching for that. I do know that there are some contracts that might slip. I also know that they are chasing some new contracts coming through, so we'll just see how that plays out. Sydney Airport is under constant negotiations because of what's happened with COVID, both on the aeronautical and the rental side, something we'll be watching for. Transurban, we get this quarterly read-through on its traffic numbers, which is so important. Dalrymple Bay, slight delay on that February announcement from the QCA. I think that'll be coming through very soon. That's a very meaningful announcement for the company, and I really think it's going to go to light-handed regulation, and that will get the share price really moving. And then for Spark, they have a major announcement to do with a regulatory reset that will come through in April. We've already got the Sydney traffic data, so that gives us a good read-through. Atlas Arteria already given us the revenue numbers for the quarter and therefore for the full year. In terms of earnings guidance, APA, look, I think there could be the potential that it actually ticks that up based on what it did with its distribution in the first half. Horizon, a bit of a risk around coal volumes and therefore what happens on its EBIT guidance. If it comes off on the numbers that I've done, it'll come off very minor, so it's not a big issue. And Cleanaway and Bingo could very well actually give quantitative guidance, given how things are stabilised. A couple of other things I think we need to point out, management changes. APA, the Transurban CFO has actually moved across to APA. Talking to him last year, it sounds like they've got some exciting stuff going on for this year, so something to watch out for. And obviously we know about Cleanaway, the CEO's leaving, the CFO's leaving. So some pretty significant changes going on there, given what we're seeing with a potential structural change in the competitors within the industry. And then something I've learnt about my sector over the years, it's that people look at it and go, it's a yield with a little bit of growth coming through. It always gets a kick along from M&A to get total shareholder returns really up. Bingo, we know in terms of potential bid, but the other guys that could be involved in M&A, at least as acquirers that I can see, APA with buying assets to try and boost its earnings. Atlas Arteria has a lot of cash sitting, waiting to go, and its French asset has plenty of gearing capability. Cleanaway, with that, those French competitors coming together, there'll be an asset sales that spill out of that. Cube, obviously with Moorebank, and Transurban, as I mentioned before, with WestConnex.